Power hook. What if I told you that every single major Wall Street analyst is making the same bullish bet on the S&P 500 for 2025? And what if I told you that this unanimous optimism might be the biggest red flag you need to watch out for? Stay tuned, because in the next 45 minutes, we're going to dissect the most comprehensive market analysis you'll see this year. Current market snapshot. Right now, as I'm recording this, the S&P 500 is trading around 6,400 levels. It's a big question, but here's the million-dollar question that every investor is asking. With the S&P 500 already up significantly from its 2022 lows, are we looking at continued gains, or are we setting up for a major correction? Today, we're going to break down 27 major analyst forecasts and what they really mean, the hidden risks that could derail these predictions, specific sectors and strategies you need to know about, and most importantly, how to position your portfolio for both scenarios. Why this matters. Now, look, we're at a critical juncture. The Fed is navigating inflation concerns. We've got ongoing tariff uncertainties. AI is reshaping entire industries, and corporate earnings are showing mixed signals. The decisions you make in the next few months could define your investment returns for years to come. Credibility and preview. I've analyzed reports from Goldman Sachs, Morgan Stanley, Wells Fargo, Tom Lee, at Fundstrat, and dozens of other major firms. We've got fresh data, recent revisions, and I'm going to show you exactly how to interpret these forecasts like a professional analyst. The contrarian warning. But here's something that should make you pause. When was the last time you saw this level of unanimous bullishness from Wall Street? History tells us that when everyone is looking in the same direction, that's exactly when the market tends to surprise us. So buckle up, because we're going deep. Deep market analysis, the current landscape. Let's start with where we are right now. The S&P 500 closed 2024 at 5,881.63. That's important because every 2025 target is measured against this baseline. Current key metrics. SPY is trading around $639, down slightly from recent highs year-to-date. We're still showing solid gains, but volume patterns and volatility suggest investor uncertainty. The market is essentially asking, can we sustain these valuations? The analyst consensus breakdown now, here's where it gets interesting. I've compiled 27 major Wall Street forecasts, and here's what we're seeing. The bulls, 6,800 to 7,500 targets. Tom Lee at Fundstrat, 7,000 conditional target. 6,600 base case Oppenheimer. 7,100 with 11% annual gain expectations Wellington Altus. 7,500 by spring 2026. Consensus average, 6,600. That's a clean 10% gain. Goldman Sachs recently upgraded their outlook various regional assess. 6,400 to 6,700 range. The cautious camp 5,700 to 6,300. Goldman's earlier conservative estimate, 5,700 Reuters poll of 35 strategists. 6,300 bear case scenarios. Suga 6,000 possible. What's striking is that even the cautious forecasts are still calling for gains. Earnings growth expectations, but targets are meaningless without earnings growth. Here's what the numbers look like. CFRA Research is projecting 2024, 8.5% profit growth already mostly realized. 2025, 13.4% profit growth. 2026, 13.2% sustained growth. Goldman Sachs maintains 7% earnings per share growth for both 2025 and 2026. These are aggressive numbers. For context, historical average EPS growth is around 6 to 8% annually. So we're talking about above-average expectations built into these forecasts. The AI revolution factor now, here's where it gets really interesting. The AI impact. Morgan Stanley has published research suggesting AI adoption could add $13 to $16 trillion in market value.
Oh.
That's roughly a 29% boost to total market cap. But let's break this down. Productivity gains from AI implementation, cost-cutting through automation. New revenue streams from AI products and services, the magnificent 7 tech stocks leading this transformation. However, there's a catch. Much of this AI optimism might already be priced in. When you look at current tech valuations, they're assuming near-perfect execution of AI strategies, investment opportunities, and strategic positioning sector rotation opportunities. Here's where smart money is positioning for 2025. While everyone's focused on tech, there are hidden opportunities. Healthcare sector, aging demographics creating sustained demand. Biotech innovations beyond AI defensive characteristics during uncertainty financial services. Higher interest rate environment benefits. Credit normalization after recent tightening potential for expanded lending. Utilities and infrastructure. AI data centers requiring massive power grid modernization investments. Dividend sustainability during volatility, international exposure. US dollar strength may moderate. Emerging markets offering value currency hedging opportunities. 22 o'clock to 25 minutes and 0 seconds. The Fed policy play. The Federal Reserve is maintaining rates at 4.25 to 4.50%. But they're signaling to potential cuts by year-end. This creates a specific investment thesis. If Fed cuts materialize, growth stocks benefit from lower discount rates, REITs become more attractive. High dividend stocks gain appeal. If Fed holds steady, financial sector outperformance likely value stocks maintain advantage. International diversification becomes crucial. The key is positioning for both scenarios. Risk management strategies, but here's what separates professional investors from amateurs. Risk management. Given the current environment, here are specific strategies. Portfolio hedging. VAX calls for volatility protection, inverse ETFs for downside. Coverage sector rotation based on economic indicators. Position sizing. No single position over 5% of portfolio tech allocation, maximum 25 to 30%. International diversification, minimum 15% defensive positions. Consumer staples for stability, gold. Commodities for inflation hedge. Cash reserves for opportunities. Timing and entry strategies. Timing isn't about predicting the exact bottom or top. It's about probability-based positioning. Here's how to think about it. Near term. Q, Sir, Arling Arwool. Range-bound trading. Likely 6,300 to 6,800. Volatility around Fed decisions, earnings, season reactions. Medium-term 202.5, 202.6. AI implementation phase, corporate margin expansion, potential for breakout. Above 7,000 entry strategies. Dollar cost averaging during volatility. Buying dips in quality names, sector rotation based on leadership changes. Exit strategies, profit taking at resistance levels, stop losses 15 to 20% below entry, rebalancing quarterly. Hidden opportunities now. Let me share some opportunities that aren't getting mainstream. Tension. Small cap value. Russell 2000 underperformance creates opportunity. Domestic focus benefits from trade policies, higher beta during recovery phases. Dividend growth stocks. Sustainable payout ratios. Inflation-protected income tax-advantaged returns. International markets. European recovery potential. Asia-Pacific tech beyond China, currency diversification benefits thematic investing. Cybersecurity growth trajectory, clean energy infrastructure, supply chain reshoring plays. Specific implementation plan, your action plan, all right? Let's get practical. Here's your step-by-step implementation plan. Phase 1, immediate actions. Next 30 days. Portfolio audit. Calculate your current sector allocation. Identify over-concentration risks. Assess your risk tolerance. Honestly, risk assessment. Set stop-loss levels for major positions. Determine maximum acceptable drawdown. Create emergency cash reserve, 3 to 6 months expenses. Monitoring setup. Track key economic indicators, CPI, EPI, employment. Follow Fed meeting schedules and statements. Monitor earnings revision trends phase. 2. Strategic positioning, next 90 days. Sector rebalancing. Reduce tech overweight if above 30%. Add healthcare and financial exposure. Consider international diversification, defensive measures. Implement hedging strategies. Build cash positions for opportunities. Establish profit-taking rules, income generation. Add dividend-growing stocks. Consider covered call strategies. Explore REIT allocations. Phase 3. Execution. Excellence, ongoing regular reviews. Monthly portfolio rebalancing. Quarterly strategy assessment. Annual goal reassessment. Discipline maintenance. Stick to predetermined rules. Avoid emotional decision-making. Document all trades and reasoning. Warning signs to watch. Here are the specific red flags that could invalidate these bullish forecasts. Economic indicators. ISM manufacturing below 45 for 2 consecutive months. Unemployment rising above 4.5%. Inflation resurging above 3.5%. Market signals. VIX sustaining above 25. High-yield credit spreads widening beyond 500 BP. Small cap underperformance accelerating. Policy changes. Fed pivoting more. Hawkish tariff implementation exceeding expectations. Geopolitical escalation affecting trade. The contrarian perspective. Remember what I mentioned at the beginning about unanimous bullishness being a warning sign? Here's how to think about it. Historical context. 2007. Universal optimism before the crash. 1999. Tech euphoria before the dot-com bubble. 2021. Everything bubble mentality. Current parallels. High valuations across multiple sectors. Excessive AI optimism. Complacency about risks. Contrarian strategies. Maintain higher cash levels than normal. Focus on quality over growth. Prepare for opportunity during corrections. Final call to action. Look, the S&P 500 might very well reach 7,000 or higher in 2025. The AI revolution is real. Corporate earnings could surprise to the upside, and Fed policy might create the perfect environment for continued gains. But as investors, our job isn't to predict the future. It's to prepare for multiple scenarios while managing risk intelligently. So here's what I want you to do right now. Pause this video and audit your current portfolio. Identify your 3 biggest risks. Set up alerts for the key indicators I mentioned. Create a simple rebalancing schedule. The market rewards preparation, not prediction. Position yourself accordingly. Summary and resources to wrap up. We've covered 27 analyst forecasts, ranging from 6,300 to 7,500. Analyze the key drivers, including AI adoption and Fed policy, identified specific sector opportunities, and most importantly, created an actionable plan for your portfolio. Remember, the consensus is bullish, but smart investors prepare for all scenarios, engagement, and next steps. If this analysis helped clarify your 2025 investment strategy, hit that like button and subscribe for weekly market updates. Drop a comment below with your biggest takeaway or any questions about implementing these strategies. And remember, this is educational content, not personalized investment advice. Always consult with a qualified financial advisor before making major portfolio changes. Preview next content next week. We're diving deep into the magnificent 7 stocks individually. Which ones are still buys? Which are overvalued? And which could surprise to the downside? You won't want to miss it.